Right, welcome everyone. Good morning. Welcome to Daily Mortgage Rates Live. We will wait just a few minutes here to get started and let everybody have a chance to jump on. But we appreciate everybody tuning in early and on time. Hope everyone's been having a good, productive week so far. And we'll put the chat up there. I see a couple people already dropping in the chat. We'll go ahead and put the chat up there. You can drop a comment when you are tuned in here. And we'll wait just a couple minutes to get started here. All right. Those of you just jumping on, we're just waiting a couple minutes to get started. Wait till we are live on all the platforms. So give us just 1 minute here. Go ahead and drop a comment in the chat there when you're tuning in. A couple people in the chat. Good morning. Good morning. All right. Looks like we are live on all the platforms. So we can go ahead and get started here. And take the chat off there. So, welcome everyone. My name is Kyle Hiersche. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. What we do here every morning is go through the live rates. You can see real life examples of some rates that we pull up with our pricing tool. And then we do a deep dive into a different subject every day. Now, today's subject that Jose is going to do a deep dive into is second mortgages. So we will get into that in a little bit. But first, Nick, let's go ahead and pull up our pricing engine and see what the rates are looking like today.
All right, sounds good. Let me go ahead and switch my screen and we'll get started. So as Kyle mentioned, this is our pricing tool for our team of mortgage professionals. If you'd like a full loan estimate, we have over 300 loan officers licensed in 22 states for primary homes, and we can do our business purpose loans for investment properties in 44 states. So if you'd like a full breakdown, please get with one of our team members. This tool is just going to show us the general rates and APRs. Today, it is April 12th, just after 11 a.m. Eastern. So we're just going to see the live rates for today. And we're going to set up a few simple scenarios. For all of our scenarios, we're going to use a 400,000 loan amount. We're going to set up an 80% loan to value, 20% down payment. We're going to ask the computer to search for the best rate at a 99 price. That means one discount point. Most of our requests are for customers are to buy down the rate a little bit. So that's our typical request. And we're going to do 3 examples. We're going to do our conforming conventional, and we'll check out our FHA, and then we'll check out our non-QM expanded guidelines, where we have over 5,000 loan programs where we can use alternative financing methods and alternative income documentation. We don't do the VA live since that's only for eligible veterans, so we appreciate any eligible vets out there, and we're happy to quote it, but since not everybody is, we don't do that live. And same thing with USDA, that's only for properties in a USDA eligible rural area. So we do not do that live, but we'd be happy to quote it if you are shopping in one of those areas. So let's start with our first example, conforming conventional. We're going to set everything to a purchase, 30-year fixed loan, primary occupancy for these first 3 scenarios, single family, 1 unit, state of Florida, county Miami-Dade, since that's where we're based. And for all of our demos today, we use an estimated FICO score of 760 and an estimated debt to income ratio of 40. So with those basic parameters, let's check out our rates this morning. So great. It looks like we have some downward movement, which we love to see. So 6.25 rate, the best combo here for one discount point in cost, and the lowest APR of 6.426 of these examples. So great example here. Remember yesterday the APR was just over 6.5, and the rate was a little bit higher. Now we're a little bit lower. We love to see some downward movement. Hopefully we see the same in some of our other products as well. So let's go back to our quick pricer here and compare to our conventional to our FHA. So typically, if a customer doesn't qualify for conventional, the next option we typically propose is an FHA, where they have a little bit more relaxed guidelines on credit and a little bit higher DTI that we can utilize. So FHA will be our next selector. We'll keep everything else exactly the same, and we'll compare our FHA rates this morning. So great, looks like these are a touch lower as well. So 5.5 rate for 0.875 discount points in cost, and a final APR of 6.098. So remember the APR there for the conventional was just under 6.5. Now this one here at FHA is just over 6, so very comparable there. And FHA typically was higher on the APR because of the additional mortgage insurance, the upfront and yearly. However, with some changes, FHA is very comparable and actually a little bit cheaper in this scenario. So definitely recommend our customers out there check out FHA as a viable option as well. Now, if for any reason our customer can't qualify with conventional or FHA, next we go into our non-QM. So many other banks and lenders do not have any other options once they surpass these. However, we have over 5,000 loan programs under expanded guidelines, aka non-QM. And let's set this back to 80 as well. We'll keep everything else the same, but notice we have a new option now under non-QM, which is our income verification. So typically for conventional and FHA, we're always doing full doc. That means 2 years of tax returns. So we would typically choose this option to go with an alternative option, such as 1 year alt doc, 2 year alt doc, using assets only. Business bank statements, very popular. DSCR will do for our investment properties here in a minute. But our most popular program by far for non-QM for a primary home would be a personal bank statement 12-month program. So in this case, we would use that for a self-employed borrower. Many times self-employed borrowers with 2 years of tax returns have various write-offs and other things that affect their income qualifications. So if there's some reason they can't qualify at all or can't qualify for enough income, instead of using 2 years of tax returns, we're simply going to use 12 months of bank statements. So their most recent 12 bank statements to determine a debt to income ratio just using their cash bank statements. So many times, or in fact, most times, our self-employed borrowers qualify for much more income and therefore a much higher loan amount using bank statements. So this is a tool for people that would not otherwise qualify. The rates are going to be a little bit higher, but again, this is a great tool for us to solve a problem and get someone into their dream house that would otherwise not qualify. So let's check out the rates this morning. Great. We see some downward movement here, it looks like, as well from the show yesterday. We always love that. So the best option here today, 7% rate for one discount point in cost and a final APR of 7.080. So remember, FHA was just over 6. The conventional was just under 6.5 on the APR. And now we're on non-QM that is just over 7. So very comparable. We love to offer all three options to our borrowers to find the option that fits best. And remember, there's dozens, if not hundreds, of different options here just under this one scenario of different programs under bank statements. So tons of different options to use bank statements. Some of these may allow things like credit events such as a foreclosure, things like that. So tons of different ways for us to do this. Please get with our team. We would love to present these for you. Now, before we pass it over to Jose for our topic for today, we always want to do a few investment property examples. So we love to work with investors here at the Mortgage Calculator, whether they're first-time investors or maybe have 10, 20 properties. We have great options. So for our next two examples, we'll set this to investment property for the occupancy. We'll do the same LTV, 80% loan to value, 20% down payment. And we're simply going to compare our conforming conventional options with our non-QM expanded guidelines. Remember, FHA, VA, USDA are not eligible for investment properties. So we'll set up our conforming example. Everything else will stay the same as we had before. We only switched investment property. So let's check out our investment property rates for conventional. So it looks like they went down a touch as well, which is always good. The best option the computer has here is a 6.625 option for 3.5 discount points and a final APR of 6.885. So it looks like that was a little bit down from yesterday, which it was just over 7 yesterday, I believe, on the show, which was surprising. So here we have an option back into the sixes here on the APR, which is great. But notice the discount points, the computer's unable to find an option for 1 discount point in cost. Even if we go up in rate here on the chart, there are some other options like 7.375 for 275 discount points, or this option for 7.49 rate for 2.375. But many of our investors would like to save some of that cash out of pocket. So unfortunately, the conventional programs have added these loan level price adjustments, aka fees, so we don't really have an option to go higher in rate. So that's where we love to quote our non-QM programs to compare. So for our final example here, we'll set this up to 80 LTV again, set this back to investment property, and we will click on expanded guidelines, aka non-QM. And we'll have to set 2 options now for these investment properties. First, our income. Most popular for an investment property is going to be our DSCR program by far, and that's because we don't need any income or employment from the borrower. We're just going to use the estimated rental income from the property to determine if that estimated rental income can cover the mortgage expenses, the PITIA of that actual property. So if the expenses are covered by the rents, the ratio is greater than 1, and we have a ton of options for that. We also have a ton of DSCR loan programs for ratios under 1 where the property doesn't quite cash flow at the moment, and we still can place that for ratios under 1. So tons of different options here. The other thing we always have to select on an investment property for non-QM is a prepayment penalty. 3 years is standard, so that's what we're always going to select. We can choose 0. That will limit the amount of loan programs available and cost more money, so we don't do that on the demo. And 5 years, we can save a little bit of money, but there are less programs that allow 5 years. So since 3 years is the most common, that's what we're going to choose for our demo every morning. Now let's check out our DSCR rates today. So looks like the DSCR rates, let's go find here. For some reason it pulled up that one first. The best option it looks like we have here for the lowest APR is 7.99 rate for 0.275 discount points and costs for a final APR of 8.046. So the APR is just about 1% higher here for the non-QM DSCR programs, but so very comparable. But notice the discount points here. Actually, we're saving a ton of money for our borrower, our investor out of pocket, so they can deploy that money elsewhere into other investment properties. So these are often the best options for our investors. And remember, they can start 2, 3, 5, 10 of these loans at the same time. They can cash out multiple properties to purchase multiple properties. Since we're not using employment or income from the borrower, we're just looking at each property individually, so we can start really unlimited of these DSCR loans. So as you see here, there's a ton of different options with different rates and costs and programs, tons of different flavors of this. We can find the one that fits best for you. And some of these may allow things like short-term rental income, bankruptcies, foreclosures, all kinds of different versions of these programs. So please get with our team, and we would be happy to quote these for you. So now that we've checked out all the live rates this morning, let me go ahead and pull up our deep dive topic for today. Let me switch my screen. And as Kyle mentioned earlier, we are going to go over our second mortgage loans today. So we talked about this a little bit last night in our training for our loan officers. Today we'll actually go into some pricing. It's a little bit more difficult to price those live. They are a unique product. They are a little bit more difficult to set up, so we don't have the live pricing example. But we can do these second mortgages very easily and quote them up. So Jose has a few examples here. We do have second mortgages, which would include HELOCs. What we're probably going to talk about today mostly, though, is our fixed rate second mortgages, which is kind of the unique product that we love to offer. Most people consider a second mortgage a HELOC. There are the fixed rate second mortgages. And the most important thing that I want Jose to touch on today is our fixed rate second mortgages for investment properties. So that's really where we see a lot of interest is investors that maybe have a lower rate first mortgage that are still looking for cash out. And instead of refinancing the first mortgage, may want to do a HELOC, which they don't really exist for an investment property. So we have a fixed rate second mortgage product. So let me go ahead and make you nice and big here, Jose. You can kind of introduce the topic, and we'll go ahead and share your examples when you're ready. So go ahead if you're ready.
All right. Let me give a little intro here. Basically, as Nick was saying, most people think that the only options that are available for the for second mortgages are home equity lines of credits. But as we discussed in our training yesterday, HE loans or home equity loans are all the rage right now, right? There's many options that we can do. We can do for primary, or as Nick mentioned, we can do for investment. So I am sharing both options here today. So let me just queue up my first example here. Just give me a second. Getting a little spinning wheel here. Okay. So my first example here that I'm queuing up is full doc, 80% LTV primary residence, right? I'm going to leave the best for last for the investment. So in this example I have right here, this is for a standalone second mortgage, what we like to call home equity loans, right? Now, this is a lender product. This is not a brokered product. So this is not broker comp. This is, how we normally do all of our correspondent deals. I want to make that clear. This is a second mortgage. Now, this is a full doc second mortgage, 80% standalone, not a combo loan with a first and a second. So in our example here, we have $100,000 second loan. The system is assuming that we had an existing $300,000 loan already there on the property that is going to remain in first position. So look at these rates here. 9.5%, right, is our lowest rate option, with 9.875% the lowest cost option. Now, if you consider where the rates are that Nick just went over today on first mortgages, these are extremely good rates. And this particular option is about 2%. That's correct. You heard me correct. 2% lower than the HELOC, which is a variable rate product. The reason being here that a fixed rate product is a lower risk factor for the investor that made the loan. There's going to be less payment shock should we have, with all this volatility that we're having in the rates, there will be less payment shock risk, actually no payment shock risk to the borrower. So hence they see that as a lower risk on the loan, which is why then you're getting a lower interest rate. So this is a great opportunity for those borrowers that do not want to touch that first that may be at 3%, 2.5%, 3%. Well, they can certainly get one of these, and then you can talk to them about the blended rate. So this is 80%. Now, let me make it a little bit more exciting for you here. This is 90%. Now, we're still going full doc here, primary, so rates did go up a little bit. Rate went up. The lowest cost rate went up by about 0.75. And you still see that you can still buy it down to 9.75%. Very good option because this is 90% combined loan to value, full doc, primary. So now we're going to make it even more exciting for you, something that hence previously was unavailable. This is a bank statement option. Now, you will note the rates are exactly the same, as is the case as with most of our non-QM investors, they tend to price bank statement option loans and full doc using tax returns, pay stubs, W-2, the traditional full doc loans. They tend to price them the same. Hence, our 12-month business or personal bank statement option here has the same pricing. I'll bring it back over here. This is the full doc option, and this is the bank statement option. Really good rates. Now we make it even more exciting. We didn't get our quote there, but so sorry, but these would be the rates right here. The rates are exactly the same for the 90% CLTV bank statement option as the full doc. So now, this is the one we were all waiting for, right? This is a 90% LTV. I mean, dude, I get goosebumps saying this. 90% CLTV investment bank statement second loan. Wow, that's a mouthful, but that's real. And I mean, if you would have told me this a couple of months ago, I'd have thought that, you pulled this out of like some fantasy land book or something. But here we have 12.375% actually offering a lender credit. And you can buy it down to 11.75%, a little bit of a cost, not that much cost there. When we consider we are looking at $100,000 loan. So this is $1050 on the buy down. So, and actually, excuse my, this is 80% CLTV, not 90% CLTV option. So this is 80% CLTV, second mortgage, bank statement, investment. So,
And to be clear, there is no HELOC for investment properties really out there, correct?
Absolutely. If you find one, let me know where it is. But yeah, it seems like all the HELOCs are for investment only. And something else that I'm going to note on the this HELOan program option. This is very interesting. This is the only option I've seen out there that allows you to go up to a 4-unit property. So we do have some HELOan options that do let you go up to 2 units. But we have this particular option here that allows you to do 3 and 4 unit properties as well. So, that's extremely beneficial to the investors, even though we do have our house hackers out there that have their primary residence. That's a 3 and a 4 unit. But normally the 3 and 4 unit properties tend to be investment properties. So we do have the outlet to do that second loan. So if your investor has that nice DSCR loan that they may have, picked up with you in December of 2021, well, now you can give them a nice second mortgage so they could keep buying more properties and not touch that really choice first mortgage loan that you gave them previously. So this is all the rage out there. Most of the companies are telling us that 30, 40, and 50% of their production right now is second mortgages. We're not talking HELOCs, we're talking HELOans, these second mortgages. So don't miss out on this opportunity to add this additional income stream to your origination portfolio.
All right, thank you. Great topic there. I do see we got a couple of questions here in the chat. If you want to highlight a couple of those, Nick. Looks like Nelson has a question there for you, Jose.
All right. Personal bank statement program expense ratio. Well, personal bank statement programs are typically 100% of the accepted deposits, whereas the business bank statement option is the one that adds an expense ratio because those are business income receipts, gross revenue coming into the business, which is, going to be subject to an expense ratio. Whereas the logic is that when it's a deposit into the personal bank account, that it's already been expensed out, and what you're depositing is your net income.
All right. Let's see here. Another question there for you, Jose.
All right, this is not related to second mortgages, but on the DSCR programs, we do have options that go up to 85% loan to value. That is the highest you're going to get out there. And credit score that I used for these examples was 800. The adjustments pretty much plateau at 760. I believe 760 is the last tier, which below there are adjustments.
All right. Looks like that's about it.
All right, great examples there. So, every day we do this show at 11 a.m. Eastern time where we go through these rates and do a deep dive topic into, a different type of loan, just like we did today with the second mortgages. So if you would like to get a personalized quote for one of these products, you can connect with one of our loan officers. We have over 300 loan officers all across the country. We are licensed in 22 states, and then we can do business purpose DSCR in almost every state, right? So if you want to connect with one of our loan officers, they are consultants that can walk you through these different programs, not only conventional FHA, VA, USDA, but things like these second mortgages and all of the non-QM products we talked about today, such as bank statement and DSCR, all the way through commercial, fix and flip, land, ground up construction. We do it all here at themortgagecalculator.com. So visit us at themortgagecalculator.com. We will pair you up with one of our loan officers, or you can send us an email, info@themortgagecalculator.com. As I said, we do this show 11 a.m. Eastern every single weekday. So we hope to see you all at 11 a.m. Eastern tomorrow. Everybody take care and have a great day.
Thank you, everybody.